Our next guest says the market is hovering near a key level, and we could be shaping up for a year-end rally. Todd Gordon of TradingAnalysis.com is over at the Plasma. He's got Plasma to break down the charts. Todd, what do you see?
Hey, Tyler. Yeah, there's a lot of discussion going on about the 200-day moving average. And a lot of people get very excited. It's broken the 200 days, so do you buy or sell? This chart that I'm going to show you says do neither. Just be aware that you're in a very big period of conflict. So to put it in context here, this is the S&P since the credit crisis low. And I'm going to show you 3 examples of times that we've attacked the 200-day and then gone into consolidation. Number 1 here is right around 2010. Again, here in 2012, a third time all the way up here in 2015 into 16. What you'll see is each occurrence lasts approximately 92 days, 100 days, 144 days. So what does that mean as we bring it to the current market situation? I would say the first time we've attacked the moving average, the 200-day, is right around October 10th. So if history is any guide to what's going to happen in the future, you tack 100 days onto October 11th, that puts you roughly into March 1. So what could that mean with everything you guys are talking about in the desks? It could mean a period of very high back and forth consolidation, whipsaw, nightmare for investors, maybe a very good opportunity for traders. So I would say don't try to trade the breakouts or breakdowns now on a trend basis. You got to be nimble in here. But as I've said, if we are going to scoop some longs, there's 2 strong sectors that we like. Number 1, consumer discretionary, XLY. We did the 200-day moving average stop run. We snapped back above it. Again, I'm not looking for an all-out breakout, but you nimble traders could try to test back up to the old highs at about 115. Let me show you this. This is the relative strength. We're taking the S&P divided by XLY, which is your consumer staples. You're starting to see this ratio turn up, which means consumer discretionary is starting to outperform the S&P. You've got Amazon, Home Depot, McDonald's. Those are your your 3 holdings in XLY. All are starting to come back here, led by XLY. Amazon at 20%. The other one, no surprise, this is a very clean, strong chart, is healthcare, XLV. We couldn't even get below the 200-day. Talk about a nice clean test there, right back up the highs. Maybe we have a little bit of consolidation here that would form what we call an inverse, kind of head and shoulders. That guy might have the ability to go up and break out to new highs. So I like XLV, XLY, and a range-bound S&P.
Looks like a demonic symbol he just drew.
Don't
there.
say that. No, why?
That looked just like a hieroglyphic. It was something. It was something.
Fast money. There you go.
Important.
Hey, Todd, I got a quick question for you. That very first chart that you showed of the S&P 500, you talked about that 100 days going all the way out to March. So you're expecting to see volatility really start to accelerate back into the market after we were at the 20, call it to 28 in that very big, large movement we had, now back to 16. But you're expecting to see volatility spike back up above 20 again, maybe even over 30 from the looks of the chart.
And you're talking VIX, right? You're talking VIX, right? I think, you know what, 12 is probably the new 20 in the VIX. So this is trading days. This is not calendar or weeks. You're talking 100 trading days. Maybe that new norm is a 20 VIX support. Yeah, we could have a real period of back and forth there in the S&P. So, you know, as a trader, stay nimble, maybe use options, right, Pete?
Yep.
But yeah, expect high volatility to stay.
All right, Todd Gordon of TradingAnalysis.com. Thanks very much, Guy. What do you think?
Well,
More volatility?
Oh, without question. I think Pedro would say the same thing, although the VIX is now below 20. But, I thought the VIX was going to top out at 30. But let me mention one specific stock that he mentioned, he being Todd. McDonald's, I think we've all been universally extraordinarily bullish on McDonald's for good reason. Stock has been unbelievable, and I think it made an all-time high within the last couple days, if not today. You look at their margins, outstanding. The last quarter was great. But you know what? At a certain point, valuation is going to matter. And at close to 23 times next year's earnings, in my opinion, McDonald's might be getting ahead of itself. And a lot of stocks find themselves in that type of, in that sort of circle of maybe we should be taking profits here.
I think you got to be tactical, is what I take away from what Todd is saying. You're in a market that is not easy to trade. It's not going to be like the last several years. You got to take your profits when you have them, and you got to buy the dips when you can. And just trade around this market. You have to be tactical.